Hello, Mandy, may I start? Okay, great. Hello, everyone. Good morning, good afternoon, good evening. Welcome to the paper session 2 for insurance risk and climate change. My name is Tianyin. I'm the Deputy Director for Research Center for Green Finance Development at Tsinghua University. This session will be moderated by me. So we have 3 presentations for this session, and each is allocated for 30 minutes, and 20 minutes for presentation, then 10 minutes for Q&A. And so probably let's start the first presentation, which is called Pricing of Climate Risk Insurance, Regulatory Frictions and Cross-Subsidies, presented by Anna Maria Tenekedjieva, Louche. Anna Maria, welcome, and the floor is yours.
Thank you, Tianyin. You can see my screen, right?
Yes.
All right,
yes.
Great. So we are ready to go. All right. Hi, everyone. This is joint work with Simon O from Chicago booth and Ishita Sen from HBS. I'm Anna Maria. I am an employee of the Federal Reserve Board, but the usual disclaimer applies. All opinions expressed today are my own. So before we begin, let's discuss briefly what is climate risk insurance. When I talk about climate risk insurance, I mean homeowners insurance, which is in the United States, one of the main ways through which homeowners can by themselves protection against climate risk. So in general, homeowner insurance provides homeowners protection against certain events. Those events usually come from either climate losses or from other liabilities such as vandalism, theft, etc. During the tumultuous mid-20th century in the States, liabilities were the more uncertain and the usual driver of price increases in homeowner insurance. But over the last 2 decades, especially, climate losses have dominated the cost of the product, reaching around 85%. So since this is one of the main ways through which homeowners can protect themselves against climate risk, it is the second largest and fastest growing property and casualty line, with written premium exceeding 100 billion as of 2019. We can even think of this product as mandatory because in order to get mortgage loan in the States, banks require that, that borrowers show proof of having homeowner insurance. And just to give you a sense, we're talking about significant expense here. On this graph, basically we compare the mortgage interest expense that people in the United States pay in each state. And you can see that on average, homeowner insurance is 58% of the mortgage interest expense. And in some of the most expensive states, it can reach, comparable to the mortgage interest expense rates. So a peculiarity about the way insurance is regulated in the United States is, first, it takes place at the state level, not at the federal like banks. And second, changing prices from the perspective of firms is subject to rate setting regulation. We established that basically the rate setting can be quite stringent and binding in some cases, which can really matter in an environment of climate disasters, since those have been on a unprecedented rise, and the loss distribution is evolving and unknown. This may require insurers to engage in frequent rate revisions. So, in other words, when we have rate regulation, it can be difficult for firms to reprice their product as often or to the degree as they want to. This friction has consequences for insurers' exposure to climate risk, and through that to the pricing and supply of climate risk insurance and household finances. In this paper, we study the implication of these regulatory frictions on the pricing and market structure of the US homeowner insurance market. There's two empirical challenges that we believe our paper can make advancement on. The first comes from measuring regulatory friction. Basically, there have been a few measures that have been tried in the past, but they're based on the filing process as it is on paper. And they may not reflect the true extent of the frictions. And to go around this challenge, we take advantage of new data, which tries to get at what is the friction in practice based on the filings which insurers have to submit. We use that data to construct a new measure of rate-setting frictions for each individual state. And just as a first preview, we document large variability in state strictness. The second point on which we can make progress is that usually when we have price control studies, one firm is regulated by one regulator. So we have a lot of selection issues when we make across firm comparisons. Here we have the same firm doing business in multiple states. This allows us to compare the same firm's response to various frictions and answer a different question. We can study the firm's pricing behavior in one state in response to the regulation in a different state. So before I continue, let me just briefly preview my findings. First, we established that these price-setting frictions are binding, and they can be particularly large in some states. And we find them to be especially high in states which are also exposed to climate losses. To move around these frictions, which are binding, we find that firms engage in large-scale cross-subsidization. What do I mean by that? I mean that insurers subsidize their business in high-friction states in which it's hard to set the price by increasing prices in their low-friction state business arms. Over time, since those low-friction states are less exposed to climate change, we see long-run decoupling of prices and risk. Specifically, we see rates growing faster in the states with low pricing frictions, which are less exposed to climate risk. And finally, we find some evidence that that in the states in which the frictions are more binding, insurance availability worsens. We see small insurers exiting, and we see growth in the residual insurance markets. And likely we won't have time to get too much into this result, but it is on the website, on our website, and you can take a look. In the interest of time, we won't get into the related literature, and we're going to jump straight into the, standard insurance pricing model and where do our findings fit. So in standard insurance pricing model, we have three inputs that determine the price. These are demand elasticity, marginal cost, and financing friction. Now, suppose that a climate disaster hits. The price can move up because of shifts in each of these three inputs. We can have insurers updating their beliefs about the severity of losses. Households may increase their propensity to buy insurance. And finally, when we have a big payout, insurers can be hitting capital limits, and that can worsen their ability to finance themselves. So in this paper, we study how responsive prices are to losses. In theory, this model is not a bad assumption to make, since homeowner contracts have short maturities and they can be repriced frequently in response to losses. However, the difference between theory and practice is that in theory there is no difference, and in practice there is. So, basically when we have regulatory frictions, the assumption that repricing can happen frequently is no longer accurate. So insurers may be unable to increase prices as much or as often as they would like to. let me give you a very brief institutional background. So for many decades, rate regulation has been taking place in the United States. And the reason why this practice started was to prevent, excessive quote unquote rates, and to make sure that consumers have access to affordable insurance, which, as we discussed, can be very important to get a mortgage loan. When a firm would like to change its rates in a given state, they have to go to that state and file a rate change request. This can be potentially very long and onerous process, with typical filing hundreds, even thousands of pages long. In those filings, insurers have to provide detailed explanation of why a rate change is requested, and then regulators decide to what degree that rate change request should be granted, if at all. Basically, we know that different states have different rules, so they exercise varying degree of regulatory oversight. And we see that on the margin of, first, the probability for granting an approval, and more so in the extent of execution times. So we take a look at these rate filings. We have access to most of them between 2000 and 2019. We basically miss 4 states, or have partial information on 4 states. From each filing, we observe the filing date, the decision date, which state it was filed on, the premiums affected, and importantly, we extract these 2 variables from it. One is the target rate change. This is how much insurers would have liked to change their rates in order to meet their internal underwriting profitability targets. Then there is the rate change actually granted. This is the rate change received. In terms of the rate, what drives rate change requests, we also, on the right-hand side variable, try to control for loss experience. And our main variable of interest there is loss ratio. We basically scale the losses to the premiums written in each state, in each year, for each firm. Our main assumption is that when we see losses going up, we expect to see more rate change requests. We also control for standards literature insurance characteristics such as assets, RBC ratio, reinsurance levels, and losses in other lines at a given firm. So our main friction proxy is measured with this discount ratio. So basically, we see how large is the wedge between rate change received and rate change targeted. We call this, I'm sorry, I haven't updated the slide, but this is what we called rate wedge. And here I plotted for all firms. You can see that there is a large wedge between what firms target and what they actually receive, with the median value being around 1/2. Based on this rate wedge, which we compute for each firm, state, and year, we aggregate over the firm and the year in order to construct a friction proxy, like a regulatory friction measure for each state. Based on that friction measure, we split states into 3 terciles, specifically high, medium, and low friction states. So our first question is, are these frictions binding? Basically, our concern is that, basically firms are inflating their targets, and that's why we see such a large wedge. So here we regress a profitability proxy, which is our loss ratio on the rate wedge. And we see that basically the higher the friction, the lower the future profitability. This result means that it's unlikely that the rate wedge is entirely driven by firms inflating their target, because then we wouldn't see this change in profitability. We also find that the measure has bite, and it's restrictive in high states, because in high friction states, because those states have higher regulatory approval times. And also we find that the higher the request, the longer the wait time. We also find that insurers' filing behavior is less responsive to losses in high friction states. So basically here we try to see whether a given firm will apply to increase their rates and how large the rate wedge is. So we regress that on the experienced losses, and we split those losses based on whether they come from medium, low friction, or high friction states. You can see that only in low friction states, after a large loss, the probability for filing increases, and similar, the rate wedge, I mean, the magnitudes are a little bit misleading, but basically the rate wedge gets larger. Like firms move farther away from their targets in medium and high friction states. So all of this is to say that frictions are indeed binding. And then the question remains, in the face of these binding frictions, how do firms move around them? We argue that they engage in cross-subsidization across states. So basically, after experiencing large losses in high friction states, they don't go in those high friction states to increase rates. They go to other low friction states. So we test this in the following setting. On the left-hand side, we have either the probability of filing for each insurer in a given state and year, or the rate change actually received. On the right-hand side, our main variable of interest is the loss ratio experienced in the year before in all states which are not state S. So basically, how does the rate filing behavior in Illinois respond to losses coming from, say, California? Now, this regression by itself is not telling us that this is driven, that cross-subsidization is driven by rate frictions itself. So to show that this is indeed what's driving the mechanism, we do two exercises. First, we split the regression. We run the regression on 3 different samples based on whether state S is high, low, or medium friction. Basically, we want to know, are some states more responsive to out-of-state losses than other states? We expect that the strict state, like California, will not be sensitive to out-of-state losses, but a less strict state, like, yes.
Anna Maria, sorry, you have still 3 minutes, please.
Yes, I have only a few slides. Great. So the other thing we do is to, figure out if the out-of-state losses are, differently influential based on which state they come from. So here are our results. In column 1, we include all states, and then in column 2, 3, and 4, we split it by high, medium, and low friction. You can see that in low friction state S, insurers request more rate changes after out-of-state losses. We find the same result for rate change received. Again, only in medium and low friction states is rate change received sensitive to out-of-state losses. In terms of our second step, we split our out-of-state losses by ones coming from high, medium, and low friction. And here we look at the response of the probability of filing and how much the rate change received actually moves. And you can see that basically, and we also restrict this sample to low friction states only. So you can see that in low friction states, insurers respond more to out-of-state losses from higher friction states, S bar. And to give you a sense of economic significance, the average insurer increases rates by 32% and their probability of filing by 13% after a large increase in out-of-state losses. So let me, in the 1 minute I have, tell you why it matters. Basically, here we construct the price index growth for insurers in low and medium and high friction states. You can see that aggregate insurance prices grew 5% slower in high friction states relative to low and medium friction states. This is confusing because the losses in high friction states tend to be higher. Still, in those states, prices grow slower. So here we try to drive this point home. We see that over time, there is decoupling of insurance prices from risk. Here we plot the price growth relative to long-run growth in climate losses versus friction. And you can see that in the long term, prices get disjoint from historical loss estimates. In conclusion, in this study, we look at the prevalence of rate-setting frictions for the homeowner insurance market, and we construct a new way to measure the extent of these frictions across states. And we find evidence for mispricing and cross-subsidization across states and distortions in insurance availability. As next steps, we recently got access to more granular data, and we hope to study some distributional consequences. And we also want to make a calculation to assess the welfare implication for homeowners. Thank you. Looking forward to your questions.
Thank you, Anna, for this very interesting presentation. As a first reflection to your presentation, I think I'm afraid that after people see your findings, after people see your findings, the one who live in higher friction state may move to who live in lower friction state may move to the ones with lower with a higher friction state, because there they can pay less for their insurance.
Right. So we're interested in studying this, but also what I only managed to preview in my findings, like 20-minute presentation, you can show everything. We do find that it is not home run for high friction states as well. We do find that in those high friction states, insurance availability decreases. So the prices are lower, but insurance availability starts to suffer over time. So
actually, it's just a joke. I should open the floor for the audience first. Yeah, and now let's welcome question from the audience. Mengdi, do you see any question from the audience? Because here I cannot. Okay, there's no question at the moment, because Mengdi just told me that the audience right now, the number of the audience is very limited right now. So probably let's wait a bit for the moment. Before new question come, I have another question, Anna, because you mentioned you have somehow classified the state into three groups with high, low, middle, and a low friction. So what is a threshold? To define or divide these three groups?
I'm sorry, I couldn't hear very well the last part of the question. What is the
threshold or the criteria? You have classified the state in terms of frictions in high, medium, and low. So what is the threshold for this division of groups?
You're asking how I classify it.
I guess
so basically, we compute the average gap between what insurers target and what they actually get, and we average that for the top 20 insurers over the period we're studying, 2009 to 2019. And if there is large gap between, rate change and rate target. That is a high friction state, right? So basically we split them into terciles. And we do, of course, several robustness checks to assume that there is no time series, like that it's not sensitive to our assumptions in terms of time period and in terms of the top 20 insurers. Right. So whether we do top
sorry. Yeah, how is like somehow distributed? Say each group you have the same number of insurers, or they are not like evenly distributed. That's my question actually. For instance, like you have 20 or 42 even, I don't know, I cannot remember the correct number, but in total you have, then how many belong to the high friction state and how many belong to the medium and lower?
So that's the thing, like we focused on the top 20 because those tend to be large firms that do business in, so every insurer, like among, not every, but like most insurers in the top 20 sell insurance in all 40 states. So it's not function of the insurer themselves, right? It's a function of the state that actually approves the rate filing. So all state does business in all 50 states, right? So we are trying to compare here, how does Illinois respond to the,
Yeah, there's the state. I mean, not the insurer, but the state. Like you have 42 states, and then these 42 states are divided into 3 groups.
Yes.
Then how many like are so-called regarded as high friction state, and how?
Oh, we just split like 42 divided, like 50 divided by 3. We classify as high. 50 divided by 3 as medium. Like 16 in each group. I think that's what you are trying to get at. So we just do a distributional split, right? We're making a comparative claim here.
Okay, I got that. Yeah. Mondi, do you see any questions now? Probably, I don't know, like the other 2 presenters. Do you have any question to Anna? If no, probably we can move to the next presentation, which is called, Sustainability Assurance and Cost Asymmetry. Will be presented by Anna Rudolf. Anna, the floor is yours. Thank you.
Thank you so much. Are you able to see my screen?
Yes, very well.
Like the presenters? This shows me whether, but okay. 1 second. Sorry, showed me the wrong video. Okay, now it should work. Okay, hello. I'm excited today to present our co-worked paper entitled Sustainability Assurance and Cost Asymmetry, which is co-authored by Alexander Bassen, Kerstin Lopatta, and Gastone, which are also from the University of Hamburg, and Sebastian Tideman, which is from the University of Exeter. My speech today is structured as follows. First, I will give you short the research question we try to answer in our question and illustrate the motivation behind our paper. And afterwards, I will describe our hypothesis development and the intended methodology which is applied. And lastly, I will present our main results and the results of our additional analysis. And then I will sum up with a short conclusion. Before I will give you the research question, I want to shortly explain what we understand of sustainability assurance. We define sustainability assurance as the voluntary review and assurance of CSR disclosure by an independent third party. And the role of this independent third party is to express an opinion on the credibility and reliability of the disclosure. And the question we try to answer with our paper is whether the voluntary sustainability assurance is reducing cost asymmetry, and if this applies, if this has an impact, a positive impact on the shareholder value. How is this motivated? Before I start with the motivation behind, I will shortly explain what is cost asymmetry as an outcome of managerial decisions. If we think of the traditional view of cost theory, we have fixed and variable costs are rise and fall with the same slope to the activity and output level. So if we have here an increase from Y0 to YH and from a decrease from Y0 to YL, this is all adjusted with the same slope. Now, if we consider cost asymmetry, now if we have a decrease in the output level, costs are not reduced with the same slope compared to an increase in activity level. And if this is now adjusted with the lowest rate, we refer or we call this sticky cost behavior. And if we have an over-adjustment in costs, we call this anti-sticky cost behavior. And cost asymmetry is induced by managerial decisions which are influenced by firm level and economic determinants which have an impact on this managerial behaviors. Now, how is this linked to to sustainability assurance? There is an increasing interest in sustainability assurance as it is argued by sustainability assurance providers that is expected by investors that firms have insurance on their sustainability reporting because it's enhancing the credibility and confidence to the capital market. But another argument we see here by sustainability assurance providers is the claim that there might be an improvement of processes, controls, and system optimization. So this argument here in the screenshot we see here, which is highlighted in pink, is that this could be interpreted that sustainability assurance has real economic benefits beyond enhancing the credibility to the capital market. And now if sustainability assurance is leading to firm improvements in the processes beyond CSR, that would induce that sustainability assurance has some unintended consequences. And also recent research has shown that sustainability gives some enhancements in managerial decision-making in the CSR context, but we argue that sustainability assurance has the potential to improve the overall information environment of the managers. How is this improvement in information environment related to cost asymmetry? Some of the most important decisions besides the investment decisions are that one related to cost management, which are done by the top management level. For example, cutting operational costs and reduce personal overhead in the case of a decline in activity levels. And as the management cannot be perfectly informed about all internal and external circumstances, they take inefficient, or there might be the potential that they take inefficient decisions, which is causing cost asymmetry, and vice versa. We argue that better informed managers take better cost-related decisions in that case, and combined with the enhancements due to sustainability assurance, from the internal information environment, we ask the question whether sustainability assurance is reducing cost asymmetry, and if this is the case, is there any impact on the overall firm value? Shortly, our this development, there are various explanations and drivers for cost asymmetry in the literature. Here, in this case, we focus on the uncertainty within cost adjustment decisions, which is the driver of cost stickiness. There are also some qualitative studies, which see in sustainability assurance the potential to enhance management information processes, reporting structures, and the improvement or the installment of controls. And it is shown that internal controls and information systems are a key determinant for the underlying information environment within a company, and this underlying information environment is essential for the quality of managerial decisions, and this results then in an overall better outcome. For instance, managers then have a better ability to reallocate capital and their resources internally. As I said, cost adjustments are resource adjustment decisions, and if there exists uncertainty regarding the future development and the required resources, managers underadjust their resources in the event of a sales decline, and this cost stickiness, however, is reduced as soon as uncertainty is resolved, and a poor information environment is also a driver of cost stickiness, as this is resulting in a higher uncertainty for the management. So taken together, that sustainability assurance is enhancing the overall internal information environment. We argue that this gives the managers a better set of information to adjust their resources to a greater extent, which is reducing the overall cost stickiness. So we state our first hypothesis: firms with sustainability assurance exhibit less cost asymmetry than firms without. For our second hypothesis, we are interested in the consequences of the part of cost asymmetry related to sustainability assurance. Until now, little is known about which level of cost asymmetry is beneficial or detrimental for shareholder value. Prior research has shown that companies with stickier costs have, for example, less precise analyst forecasts, which could result here in less optimal investment decisions by investors. And prior literature showed that showed consequences of sustainability assurance until now on the external information environment. So sustainability assurance is amplifying the effect of non-financial disclosure on the internal information environment for external shareholders, which is resulting in more precise analyst forecasts and lower cost of capital. And for the internal information environment, qualitative studies see here the potential that sustainability assurance assists managers to reallocate their resources more efficiently. And based on enhanced internal information environments, prior research showed that this results in better management decisions, which results in overall better output measured by investment decisions, higher M&A quality, a more efficient internal allocation of capital, and an overall higher performance. And based on this thoughts, we formulate our second hypothesis that the SA-related part of cost asymmetry positively influences shareholder value. For our first hypothesis, to capture the portion of cost asymmetry which is related to sustainability assurance, we extend a cost asymmetry model which is developed by Kaspareit and Lopatta, and rolling 5-year pooled cross-sectional regressions by GIX factor. Here our measure or proxy for the changes in output level is delta sales, and our measure for the changes in input level is delta SG&A. And D is here a binary variable, which is taking a value of 1 if there's a sales decrease in the current period, and 0 otherwise. And we're interested in our main variable of interest, sustainability assurance, which is taking a value of 1 if a company has a sustainability assurance engagement in the current period T, and 0 otherwise. And we also include a vector of firm level determinants, which have an impact on cost asymmetry and are used by prior literature, such as asset or employee intensity. And here now, if looking at this equation, we can separate for 2 effects. The first one is the terms which are multiplied by log delta sale. This is how firms adjust their costs in response to an increase in sales. And then the second one, the effect we're interested in, is the difference between the upward and downward cost adjustments, so the cost asymmetry, which is influenced by sustainability assurance and the firm level determinants. And as we want to analyze the effect of sustainability assurance on cost asymmetry, we are interested in the coefficient μ1, and here a value larger than 0 would imply cost anti-stickiness, and a value smaller than 0 implies cost stickiness. And as we expect a reduction overall cost asymmetry, we expect the coefficient μ1 to be positive. Then for our second hypothesis, to test the association between the SA-related part of cost asymmetry and shareholder value, we estimate the following shareholder value model. Our proxy for shareholder value is Tobin's cube, and we compute the part of cost asymmetry which is driven by sustainability assurance by using our estimated coefficient μ1 from our rolling 5 years regressions by GIG sector and multiply it with the firm level value of sustainability assurance. And we also include as additional control variables the part of sustainability assurance, the part of cost asymmetry, sorry, which is not related to sustainability assurance, and also the error term from the estimated regressions in the first step, so the unexplained or unexpected part of cost adjustments. And also we include a vector of control variables which were identified by prior literature to have a relationship with shareholder value. And as we expect a positive relationship between the SA-related part and shareholder value, we expect the coefficient on SAC to be positive. Shortly, due to the restricted time, our sample selection for our first and second hypothesis, we have roughly 10,000 observations for our first step of the analysis and 5,000 for our second step of the analysis. And the key takeaway here is that we apply a multinational sample, which includes observations from over 42 countries. Then the main results for our first hypothesis, the effect of sustainability assurance or the relationship between sustainability assurance and cost asymmetry. Here, our main variable of interest is the coefficient on D times log delta psi times SA, and here, which is capturing the effect of sustainability assurance on cost asymmetry. And here, our estimated coefficient is positive and significant, which is indicating a greater cost adjustment for firms which undergo sustainability assurance in the event of a sales decline. And the part of cost asymmetry which is not related to sustainability assurance has a mean value of minus 293, which is indicating that firms have an average and sticky cost behavior, and that the positive coefficient on sustainability assurance times log delta psi times D is showing that firms which undergo this sustainability assurance have a lower degree of cost asymmetry. Then, after calculating our firm level measure for the SA-related part of cost asymmetry, we from the second step of our analysis, and here the coefficient of SAAC on Tobin's cube is positive and statistically significant, and from an economic interpretation, one increase by 1 standard deviation in SAAC results in a 1.759% increase of Tobin's cube relative to the sample mean of Tobin's cubes, which is supporting our second hypothesis. And we also perform a sample split by only including the observations where the SA-related part of cost asymmetry is associated with cost stickiness, and show hereby that this is indeed driving the shareholder value. Then in our additional analysis, we acknowledge the fact that there might be some heterogeneity concerns. First of all, there is the concern that a firm's engagement in sustainability assurance might not follow an exogenous process, so that firms which do have sustainability assurance might be substantially different from firms who do not have, which do not have sustainability assurance. And for that, we apply a Heckman correction for non-random selection of sustainability assurance. And in our model of choice to adopt sustainability assurance, we include determinants for companies adopting sustainability assurance identified by prior literature, such as size, the visibility, profitability, the leverage, and the legal enforcement of a country a company is headquartered in. And after performing our first and second step of the Heckman correction, our coefficient on our main variable of interest, T times log delta sale times SA, remains positive and statistically significant. And then we also acknowledge the concern that the observed results might not indicate a causality on of SA on cost asymmetry, but are rather the observed results of common top level managerial style, as the top management is making the decision to have sustainability assurance as well as they undergo cost adjustment decisions. And for that, we apply an instrumental variable estimation. As our instrument, we use media attention towards sustainability assurance for each country. For this, we use the number of articles related to sustainability assurance related keywords issued in each country, in each year in the news databases or covered by the news databases Factiva and LexisNexis. And as we have here in our first step an endogenous interaction term, we apply the three-step procedure according to Woodridge and De Colli et al. To avoid biased estimates. And after performing our instrumental variable estimation, the coefficient on our main variable of interest remains positive and statistically significant. We also performed additional analysis on the level of sustainability assurance and also a battery of robustness checks. I will skip this now due to that I've already reached the time limit, and we'll come to the conclusion. So our study analyzes the impact of sustainability assurance on internal processes and cost structures beyond the CSR context. And with our findings, we mainly contribute to 4 strands of the literature. So we add to the usefulness of voluntary audits. We add to the literature dealing how single CSR activities are related to the shareholder value. We add to the literature dealing with the determinants of cost asymmetry and also the consequences of cost asymmetry. And by showing this impact of sustainability assurance on internal processes and cost structures beyond CSR, our findings give implications here for investors and firms by showing that sustainability assurance has real economic benefits, which are also applicable from the firm internally. And that there's a potential for an increased demand for sustainability assurance services, as firms has also here the opportunity to benefit internally. And we also think that this is relevant for regulators, especially regarding the ongoing regulatory changes. Recently in the EU context, with the new CSRD, sustainability assurance will become mandatory within the next years. This was my presentation. Thank you so much, and I'm looking forward to your questions.
Thank you, Anna, for the very interesting presentation. Let's open the floor for the audience for questions. I don't know whether this time do we have any questions? It seems no questions so far. Actually, Anna, actually you have enough time to present your process. I mean, the last 2 or 3 slides, but I don't want to disrupt you.
Yes,
yeah, please.
Yeah, I saw that I've reached the 19 minutes when I was at the additional analysis, and then I said, okay, maybe we can go over that during the Q&A if somebody is asking something.
Yeah. I mean, to be honest, okay, there's one question. Let's see. The question is the impact of SA on the internal process? Oh, sorry, is the impact of SA on the internal process is positive or negative, and how much or how can we measure it? That's one question from Jiayu. Yeah.
Okay, I think as we measured, what we suggested is that this impact is of course positive because you have an in-depth review of all the underlying reporting processes, the data structures. There is communication with like the headquarters and different sites. You have enhanced communication then, and you have another or more exchange of information within the company. Yeah, I think the impact is positive, but it's hard to measure this impact directly. So we decided to look at the effect of sustainability assurance on cost asymmetry, because this is something we can observe by the accounting measures or by the public information we do have. Yes, I hope this is answering the question so far. Is there a reason why you choose rolling 5-year-old as in the main estimator? We also performed our analysis with different windows, like the 5, I think 4 and 3-year window. We decided to stick to the 5-year window according to the paper of Kaspareit and Lopatta, which established this measure, this firm level measure of cost asymmetry. And due to our sample size and the restriction that we wanted to have at least 100 observations per rolling regression to have unbiased estimates, we decided to use a 5 years rolling window.
Thank you. And I don't know whether Quyen, do you think this answered your question?
Yeah, it answered my question. Thank you.
Okay, thank you. We still got like 8 minutes remaining. I got one question. Probably it's very naive question. I mean, I'm not sure whether you have explained this or not. So probably I missed this. SA. I mean, what's the difference between SA and the CSR? Or how do you say measure SA? Like with a, how do you indicate? In which way it is indicated? Yeah. So quantitatively.
I didn't get the first part rightly. So you asked me what's the difference between CSR and sustainability assurance?
Yes, what's the difference between SA and CSR? Yeah.
I think CSR are all the activities a company undergoes in this context of environmental, social, and governance. So like all the activities, and the sustainability assurance is only the process, the verification, the audit. Of course, it's a single element of CSR because it's good for a company to have it. But I think we look at it more from the assurance process perspective. And we indicate, or we get the information from sustainability assurance of whether a company has an external assurance or not from the Asset4 database. But we also verified this information on this variable by hand collection, as for example, we found that especially Japanese companies do not have a real formal sustainability assurance. They rather have often also a CSR opinion, which is more an evaluation by an expert of the strategy of a company. And as we are really interested or more interested in this formal assurance process, which is looking at the controls and reporting processes, we excluded then this observations, or we coded then these observations as 0 and or something.
Thank you for the explanation.
You're welcome.
Mengdi, do we got further questions? Okay, great. Thank you very much, Anna, for the very good presentation. And then probably we move to the next slide or presentation today. Thank you. Yeah. The last presentation for this session is called "In Search of Climate Distress Risk," presented by Nguyen. Nguyen, welcome. Yeah. And then we can see your slide now, and then the floor is yours.
Yeah, thank you, Dr. Sun. Good morning, good afternoon, good evening, everyone online. First of all, I just want to say thank you again for this chance to present at the GRASFI conference for this paper entitled "In Search of Climate Distress Risk." This paper is part of my PhD thesis, and this is written together with two of my PhD supervisors, that is Associate Professor Ivan Diaz-Rainey and Dr. Duminda Kuruppuarachchi. And we all work at the Climate and Energy Finance Group, Department of Accountancy and Finance, University of Ottawa, New Zealand. So for this paper, first of all, I just want to provide a little bit background in terms of the reason and the research question behind this paper. So like the title of this paper is that is "In Search of Climate Distress Risk." And with that, our subject of interest is climate distress risk. More specifically, we want to understand whether climate risk has been realized in the distress risk or default risk at the corporate level. And so if yes or if no, the following up question will be like, do we have like different results if we use a backward measurement of climate risk like corporate carbon footprint versus when we use a forward-looking measurement of climate risk, that is the climate risk disclosure in 10K filing. For this paper, actually, we have a lot of motivation. One of the biggest motivation comes from the fact that we know that climate change is now a very popular topic in terms of the finance literature. However, most of the paper up to this moment, they focus more on the market risk component, meaning that they search for the price effect of like carbon, or they search for the price effect of sea level rise among the mortgage portfolio. However, we don't see such a big literature in terms of the credit risk component. However, I could argue that the credit risk component is also as important, because we know that the global loan portfolio is much bigger than global equity portfolio. So that is one of the biggest motivation. And then the second motivation also come from the literature, in the sense that the prior literature, when they look at the climate change and the impact of climate change on credit risk, most of their research stop at the debt instrument, like the corporate loan or the bond. However, we know that for this kind of debt instruments, normally they have very indicative price, meaning that they often move together with the other similar instrument on the market. And also they have very distinctive feature. For example, they have embedded option, they have debt covenant, they have different maturity, and all of those make it very hard for distinguish the effect of climate risk on credit risk. So that is the reason why we focus on the corporate level default risk, and we use Merton distance to default model to measure this default risk level. And so our last motivation, and I'm going to talk more about that, is that the proxy of climate risk up to this moment in the literature is either too generic using ESG score, or too narrow, scope 1 direct emission. And I'm going to talk more about that in the next slide. To motivate more about our research, one of the biggest motivation also comes from the fact that we have seen a lot of anecdotal signal out there, so that climate risk, even though it seems to be a long-term risk, it has already been realized and it seems to be a contemporary phenomenon. And so if everyone remember, back in 2019, we have the California wildfire, and with that we also have PG&E, which is the very big utility firm in California. They filed for bankruptcy. And with that, on the Wall Street Journal, they mentioned that PG&E is the first climate change bankruptcy, but probably not the last. We see a lot of coal industry, a coal firm, they submit Chapter 13 bankruptcy, And we also see a lot of action from like S&P or like from Moody's. Those are the credit rater. They also like have some kind of signal saying that they start to like realize climate risk in their rating. Then last but not least, we have like a lot of like bank. They say that they are divesting from a fossil fuel industry. Also at the same time, there's a lot of bank. They also provide extra billion of dollars to expand a fossil fuel industry. And so that is like a very like a big motivation for our research. That is, we want to understand whether this anecdotal signal can be translated into a real and meaningful evidence. So just now I mentioned that the past proxy of climate risk is either too generic or too narrow. And when we say so, I am talking about like ESG score. So we know that normally ESG score is used to proxy for, sometimes it is used to proxy for climate risk. However, if we look at inside ESG score, we know that ESG score is actually very noisy. They combine like in the case of Raffinity Aiken, they combine up to 450 measurement, and then in which like information in terms of climate risk is narrowed down to just a 1 or 0 indicator, or it is narrowed down to a ranking that is adjusted industry-wide. And with that, we think that like maybe ESG score is not the best proxy of climate risk. Then another proxy of climate risk that people often use is, of course, carbon footprint. However, if we think about carbon footprint, we know that like we have scope 1, scope 2, and scope 3 emission. Mostly people just use scope 1 emission because this is the direct emission at the as the location of the firm. However, we know that like the impact of firm is expand more than that. It can expand it to the indirect emission via purchase electricity, that is scope 2 emission. It can also extend it to like scope 3 emission, and that is the emissions in the upstream or downstream supply chain. And then with that, we also have the problem of like data quality, because scope 3 emission is like there is very limited firm that actually disclose even scope 1, scope 2, and scope 3 emission. Scope 3 emission have double counting issue. And also we know that like carbon footprint, it only measures transition risk. And we think like, how about physical risk? What should be the right proxy in here? And so with that, we think that like instead of like ESG score, instead of carbon footprint, maybe we can look at another type of proxy, that is the disclosure in terms of climate change in 10K filing. And for 10K filing is the annual filing that the public firm have to submit it. I have to submit to the US public firm have to submit on annual basis. And that in 2010 we have a commission guidance from SEC, and they mandate that all of the firm that US public firm, if they have like material climate risk, they should disclose climate risk in their annual filing. And the impact is not limited to transition risk only. It should be like also the physical risk, and it is not at only local level. It should also like the impact from international accord on climate change. So with that, we are thinking that like the disclosure of climate risk in 10K filing, first of all, they cover both current and potential impact. And secondly, it covers the whole spectrum of climate change. And with that, we think that it may be a more direct proxy of climate risk if we are looking at the US firm. And so in here, what I am showing here is a climate risk disclosure report compiled by Seret and Cook ESG. And so this is an online disclosure tool. And here you can go in and you can search for whether a firm disclose about climate risk or not. Sometimes they disclose like climate risk generally. For example, they just say that climate change, for example, they just mention climate change generally. We will not know that it's a physical risk or transition risk. Sometimes they mention about rising average temperature, drought, hurricane, sea level rise, extreme weather event. We know that this is physical risk. And sometimes they mention about regulatory risk. And And so that is our greenhouse gas emission reporting. And we know that is transition risk. And that is where we are going to use in order for us to measure if climate risk does impact the firm level default risk at all. In terms of literature, like I said, this paper is related to like 3 different strands of literature. One is to look at the relationship between the ESG score and credit risk. Mostly what they find is that the firm with the higher ESG score also have a lower CDS spread. And they also find that like firm, for example, back in 2020, Sellier et al. Have a paper, and they find that firm in the high emitted industry, or they have low sustained analytic E score, they have like lower credit rating, as well as they have higher yield spread on corporate bond. Or like Chava et al. Back in 2014, he found that like firm with climate concerns in MSCI KLD, which is also a very like popular ESG score system, have a higher cost of debt. Our paper is also related to the paper that look at the relationship between carbon footprint and credit risk, as well as the paper that is linked between climate risk disclosure and different measurement of firm financial performance. However, the 2 most important paper that we are linking in here, one is the paper by Capasso et al. In 2020, find that like higher scope 1 emission is associated with lower merchant distance to default, and it is on a global sample firm at investment grading. And then the other paper that we are also linked with is the paper by Colbert et al. In 2021. This is a very interesting paper. What they did is that they changed a machine learning model to differentiate between transition risk and physical risk in 10K filing, and they link between that disclosing risk versus the CDS spread, and they find that actually if you disclose transition risk, it increase the CDS spread. However, if you disclose physical climate risk, it leads to a decrease in CDS spread. And so this is quite an interesting paper, and these are the 2 papers that we are building upon. In terms of like methodology, what we are looking at, like I say, we are looking at US S&P 500 non-financial firm in 2010 and 2018. The reason why we choose 2010, of course, is because after the SEC disclosure requirement, we have the data up to 2018 so that we can cover the Paris Agreement in 2015, as well as the Trump withdrawal and Trump like election in 2016 and 17. Our model is a dynamic model in which distance to default of the firm I at time t is a function of the past realization of distance to default, climate risk at firm level, some other firm control variable, firm fixed effect, year fixed effect, and random error term. Notice that the reason why we choose the dynamic model is because distance to default is very sticky. The past distance to default often affect the current distance to default, and with this model, we cannot like employ like normal OS regression due to concerns of upward bias. So what we did is that we use a dynamic system generalized method of moment estimator. And this method of moment estimator, they use the internalized instrument, and they can deal with endogeneity problem. Either it's come from reverse causality, heterogeneity, or most importantly, the dynamic relationship in terms of the distance to default. And this one is a kind of like a very popular model in terms of distance to default measurement, in terms of like distance to default impact up to this moment. So for those of you who are not very familiar with distance to default, actually this is quite simple. On the right hand side, I have here a chart, and so distance to default, it assumes that like from it has some assets value, and the assets value should be always like above the default point of it. That is the level of debt that firm is like taking. Normally it will be one short-term debt plus like half of the long-term debt, And the assess value of the firm, it follow a random walk process. And the moment that the assess value fall below the default point, that is when the firm go bankrupt. So distance to default at the end of the day, it's just a standardized measurement of the how far the assess value is different from the debt value of the firm. And so like if we fit that into a cumulative normal distribution, a distance to default of 1 is equivalent to 15% probability of default. And normally we cannot like have the assess value, we only have the equity value. For assess value, we have to go through a iteration process to come up with the distance to default variable. So that is our measurement on the dependent, on our Y variable. On the main variable of interest, like I say, we use the carbon footprint. We use carbon footprint normalized by revenue from the Raffinity Aiken. We use either estimated carbon intensity, total carbon intensity, or like we also divide it into scope 1 and scope 2 carbon intensity. From the beginning, we already decided that we will not follow with scope 3 emission, merely because, first of all, the data quality is not so good, and secondly, because there is double counting issue. However, if we do not find anything with scope 1 emission or scope 2 emission, probably we will not find something with scope 3 emission also. On climate risk disclosure, like I said, we use the number of climate risk keyword in 10K filing, and then we reclassify it from a very generic climate risk keyword into like regulatory keyword, that is like greenhouse gas emission regulation, the Air Act. We also have like physical keyword like the mention about extreme weather events, sea level rise, adverse weather, hurricane, storm damage and stuff. We also have non-specific keyword, that is when they just mention like climate change generally and not like mention about like the regulatory impact or the physical impact. I'm not going through the sample size because this is I have some limited in time. I'm just going to the main result real quick. In this chart, what we are showing is that we are showing the average carbon intensity of the S&P 500 firm over time. We see that like generally we see that there seems to be a downward trend, in the sense that over year it seems to be the carbon intensity is reducing, and the same thing is happening with the climate risk keyword. And actually it is not, it doesn't come from the fact that firm is being greener. It is not the case. This is just that the smaller firm with less polluted profile are disclosing more. So before, only like polluted firm disclose, they have high climate risk, and then later on like the other firm also disclose, and so because of that we can see that like the intensity reduced. We also like plot the distance to default, again carbon intensity, as well as climate risk disclosure. We choose the least carbon intensive firm versus the most carbon intensive firm, and the same thing for climate risk disclosure. There seems to be an impact in here. Firm with least carbon intensity it also have a higher distance to default. And the same thing with climate risk intensity. We see that the gap is very like consistent. In 2015, we have the Paris Agreement. There seems to be a impact here. We are not sure yet. We are not sure if the impact is like persistent, or is that just a temporary impact. So that is something that we are going to look at later on. This is our main result. In each of the columns, we are showing the impact of different proxy of climate risk versus distance to default. We find that like carbon emission in the context of S&P 500, it is negative. It has a negative impact on distance to default. However, it is not significant at all. And this impact, the insignificant is persistent. Either we use estimated carbon intensity, we use scope 1 or scope 2 intensity. With climate risk disclosure, it is another story. We find that actually like the disclosure of regulatory risk negatively impact So if firm have more like disclosure of climate regulatory risk, it actually like impact the distance to default, and this result is very significant. And this result still like hold even if we put both of the measurement into our regression. So our conclusion is that climate risk does have an impact on firm level distance to default. However, it's only on the transition side, and this is only on the discussion of climate transition risk in annual filing. So that is our first main finding. Our second main finding is in terms of the impact of the Paris Agreement in 2015. So what we did is that we fit this different model, and we measure the interaction term of the 2015 event or the post 2015 periods with the climate risk disclosure. And so what we find is that in 2015, by the end of 2015, the impact of climate risk is strengthened by the Paris Agreement, signaled by very significant impact of this interaction term. However, this impact doesn't seem to persist after 2015, and mostly because we have the election of Trump in 2016 and the withdrawal of US out of the Paris Agreement in 2017. So that is our second main result. Our third main result is in terms of like when we look at the firm with the highest climate risk. So what we did is that we divided our firm sample into those that have the highest climate risk disclosure versus the firm with lowest climate risk disclosure as well as carbon footprint. And so what we find is that the impact is significantly strengthened in the group of top 25% firm. We found that like between the top 25% firm with the highest climate risk disclosure, they are different versus the firm with no disclosure at all or no climate risk at all, the lowest one by 4 distance to default. So that is our another result that we have. We also like wonder what if the firm is operating in the state with strengthened carbon price initiative, because we know that US is very like heterogeneous in terms of their carbon price policy. Some firm with within the IIGF initiative, they have carbon price. Firm in California also subject to carbon price. And so what we want to understand is that if the firm is in the state and those states, do they have a stronger effect? And so what we find is that like if the firm is in those states, surely the impact of climate distress risk is much stronger. And again, the impact seems to be on the regulatory risk only. And it makes sense because we are looking at the carbon price, and this is a proxy of transition risk. So that is our main result. So in conclusion, what we found is that climate risk have already a negative impact on S&P 500 firm distance to default. However, we find that this impact is limited to transition risk only, to the disclosure of this risk in annual filing. We see that like carbon footprint or the disclosure of physical risk doesn't have a similar effect. We find that the Paris Agreement in 2015, they strengthened the negative relationship between climate risk and distance to default. However, this effect is kind of like temporal. It disappears in later year. The climate risk effect is stronger with firm with the highest climate risk, that is for sure, but also which firm in the headquarters in the state with stricter carbon price regulation. So that is our conclusion. What is the implication from this conclusion? We find that like for now, climate distress risk should be reflected in the credit risk model already. And if not, it should be. Then the second like implication is that when we look at like climate distress risk, we should not like narrow ourselves at the traditional measurement like carbon footprint proxy, but we should like move forward because climate risk is more like a long-term risk. and it is cover both the current and future impact. So yeah, that is the end of my presentation. Whether if you have any question that you want to ask.
Thank you, Quyen, for the very interesting presentation. Let's first see whether there's a question from the audience. Also no question. So actually, I wonder, yeah, actually also I do something similar to what you are doing. I'm always like thinking, whenever we talk about the climate risk, I think the first question to ask is, how much do you think the current, like as you mentioned, the credit risk model or the asset pricing model has already incorporated all these factors? Because we are trying to estimate a delta effect, right?
Yeah.
So what is the benchmark? I mean, whether the benchmark is 0 or something has been already pressed in. That is my question. I would like to hear your opinion.
Yeah, so my opinion is that it should like, my understanding is that like climate risk should already been reflected in the credit risk model, however, as a low level, and it is at transition risk. And the reason why I think so is because like the credit risk model, it should reflect the current and the future impact of climate risk. However, the current like climate risk impact, if we look at the regulation only, we have very low carbon price. We have very like some of the states, they don't even have carbon price at all, and so the impact on the financial performance of climate transition risk up to this moment, it should be kind of like minimal. However, now that like we have a lot of like bank, a lot of credit rating agency, and a lot of like market participants start to reflect climate risk and know that this is a long-term effect. I think that for now, the effect should be greater than 0, and it should move bigger, and it should also extend to like physical risk. The problem with physical risk is that it is very hard for you to measure physical risk at firm level. So that is the reason why it is hard for people to measure that kind of risk. If they cannot measure the risk, they cannot price the risk. That is my understanding.
Thank you, Quyen. Actually, you also mentioned something about, so somehow you have also considered, included the physical risk in your study. It's not very clear to me. How did you measure this risk in your study, actually?
Yeah, so what we did is that we looked into the 10K, the annual filing of the US firm. And so if they mention more about the physical risk impact, for example, if they talk about sea level rise, if they talk about a hurricane, or they talk about a storm, extreme weather event, 10K filing or annual filing is a very like, how to say this, it have very like large implications. So firm cannot just like randomly put some of their, you know, measurement of risk into the disclosure. So the moment they put that mention of like climate risk, like physical risk into that, we are going to assume that they are vulnerable to like climate physical risk. And so that is the reason why we calculated physical risk in that sense. I think that there's a lot of paper also have the same like assumption of following the same thought process. One paper, like I said, is the paper by Cobell et al., and that paper is build a algorithm to differentiate between transition risk and physical risk in 10K filing. Yeah, and then another paper by Sono et al. Also look at like physical risk and transition risk in the earning call. So that is the same process that people are doing, and so that is the reason why we are following that same process for now.
So the assumption is actually means if there's more disclosure about physical risk for specific firms or enterprises, they are more vulnerable to this risk, and then therefore they should have a lower valuation than also worse DD, distance to default.
Yeah, that is the assumption.
Okay.
Yeah, but like only transition risk have that impact. We don't see a physical risk impact yet. So yeah.
Okay, clear to me. Thank you.
Thank you.
I don't know whether there's other question or not. Let me check. Okay, Mengdi told me again, there's no further question. I don't know whether we can end here or not. Mengdi, please let me know. Okay, she said our audience seems very shy. I don't know whether it's because, I mean, if there's no question, it could be also an indication that all the presenters made very clear, made their point clear enough to allow no questions. Okay, then if there's no further question, I will take the liberty to end this session. And many thanks to the three presenters, Anna, Maria, and Quyen, for the very interesting presentations and the findings, and also many thanks to the audience who participate in our discussion today. I wish you a good day and good evening, and thank you very much, and bye-bye.
Thank you.
Thank you.
Thank you. Thank you.
Bye-bye.
Bye. Bye-bye.